Hey, welcome back to the Scaling Smart podcast. Thanks for joining us today. So, this episode is all about the healthcare credit bullet. So, this is how clients can find themselves getting behind on their taxes, in trouble, and how tax advisors can help prevent it. So, this one's going to be a little bit more toward taxes here in the US. So, we won't get too technical when we're talking here on this one. But I want to just show you how a couple of situations I've run into and lessons learned from them. So some tax bills are predictable. Clients expect that they're going to have a tax bill. Even if they come to you for like compliance only. Some of the tax bills can be downright brutal. So what we're talking about here is the healthcare credit that clients don't plan ahead for. So when a client doesn't plan ahead, they walk into your office, or they reach out to you during tax season thinking I should be getting money back, only to find out that they owe, or they're not getting anything back and they have a big balance due. So today I want to talk about one of the most common traps that are affecting taxpayers and tax preparers, because especially business owners and real estate investors can get caught off guard with this. It's what happens when healthcare premium credits collide with unexpected income. So trust me, you don't want to be the accountant that has to break this news to a client after it's too late. Because I'll give you an example. I have a client who was doing a 1031 exchange and ended up getting hit with a massive tax bill. So I had a client, they were a real estate investor and compliance only. They only wanted to pay for the tax return preparation. And it was even a stretch to get them to sign up to pay me to do their bookkeeping. They said they'll do it themselves. Tax season rolled around. They still didn't do it. You guys know how that goes. So, which is one of the reasons why with my firm now and in trying to scale smarter, we don't accept clients that are tax compliance only. You have to come in with advisory services and or come in with bookkeeping. And the reason why is what I'm going to get into with this client situation. So again, they wanted nothing to do with tax planning. It was even a stretch getting them to sign up to do their bookkeeping. And then when they finally said, no, we got to get our taxes done, go ahead and do the bookkeeping, do the tax prep. What ends up happening is because they didn't want to pay extra for advisory, tax season rolled around, and guess what? They did a 1031 exchange last year. They didn't reach out. They didn't tell me about it. I'm finding out about it in May. And this 1031 happened, last October, right? So what happened when I went through the paperwork is they didn't reinvest all of the funds. So anybody that knows how a 1031 exchange goes, you sell a property with the gain. You have to reinvest all the proceeds. You don't even get to touch the money. It goes to an intermediary. They have the money. You have to use it on property B. You sell property A, reinvest all the money into property B. But guess what happened? They could not find property B at the right amount. It wasn't enough property. So what they did was they got $100K. Let's just say it was over $100,000. They got over $100,000 of the proceeds that became capital gains. So new income to report that they weren't expecting. So they probably assumed, hey, we're going to pay capital gains tax on that. Yeah, they're going to let us know. But guess what? The healthcare premium tax credits, that's the part they weren't expecting for. So it now meant when they came to me, they had to, one, pay capital gains tax on the unspent $100,000, and they had to, two, pay thousands of premium tax credits because they no longer qualified with all this new income. See, year after year, they would be filing their return, taking big depreciation, writing off improvements to the property. And then by the time they finalize their net income, they'd have it low enough to where they did qualify for those credits. But they didn't want to, like I said, they didn't want to pay for advisory services. They didn't want to do check-ins with me throughout the year. And I had them as a client just to do their taxes. So here's what happened, comes around tax season. They just figured, hey, I'll let the accountant deal with it during tax season, and this isn't how tax planning works. If you're only checking in once a year with me and you're not doing planning, you're just doing tax preparation. And, clients like this, they end up blaming their accountant even though they never invested in that additional planning relationship. So how advisors can separate taxes from healthcare to get ahead of issues like that. That's what I wanted to talk about today. So if you're starting or growing your own accounting firm and you want to build a business that works for you on your terms, you're in the right place. Every week we'll dive into real life firm strategies, how to charge more, work less, use better tech, and move up the advisory ladder. So whether you're tired of compliance chaos or you just want to scale without burning out, this show gives you the tools, the stories, and templates to do it smarter. So subscribe, hit the bell, and join the other accountants who are working smarter, scaling faster, and building the lifestyle firm they actually want. Here's the thing, healthcare.gov, they're basing your premium credits based on your estimated income for the next year. So when you sign up in November, you're telling them, hey, it's November of this year, and I'm estimating what my income is going to be next year, and then we're going to reconcile it the following year when I do my taxes. So let's paint a picture. In November of 2024, we tell them we're going to make, 50 grand of income in 2025. That's what they base the credits on. And then come 2025, let's say you made 150 grand. Yeah, you didn't qualify for the 50 grand income credit, so you end up paying it all back. The thing is just knowing, when you work with an advisor, a tax advisor, what my firm does, we don't charge you based on what your tax bill ends up being. We charge you for the advice. We're charging you to keep you aware, keep you in the know, let you have an idea of what you're going to pay so that when you apply in November, you're not doing things like getting too high of a credit that you're going to end up having to pay back. Or if you're checking in with us throughout the year, you kind of can time that 1031 exchange or that big capital gain to a following year or something like that, an installment sale. So when you apply in November, you're estimating next year's income. If your actual income is higher, those credits end up having to be repaid. And I mean, we're accountants, we're tax accountants. Why do we have to deal with this kind of stuff? It's something that when you submit a return, and if they didn't include their 1095A, their healthcare credits, it will get rejected. And they will say, hey, you forgot to put your healthcare credits that we know you get. So you have to go back to the client and say, hey, your return didn't go through because they said you had healthcare.gov. Send me that form, and then I'll show you what that form looks like, 1095A. When you look at it, you'll be able to tell whether they got credits from the government or not. So again, extra things that they put onto us as accountants that we have to deal with and kind of break the news and kind of be experts in it and explain to our clients how this works. So it just the way I see it is it's another opportunity to only sell tax advisory services. And this should be something you're asking your clients about when you meet with them, when you onboard them. Hey, are you optimized? Are you doing your health insurance from the right account so we could get you a self-employed health insurance deduction or whatever you have? Do you have a group plan for your business? Because then if we're ahead of it there, we'll find out, oh, no, I'm getting credits from the marketplace, and you could get ahead of it. Well, hey, your income doesn't match somebody who would qualify. Or maybe it's a strategy where they end up doing it, timing it based on they have a big influx of money one year and they're going to live off of it for future years. So tax planning is not one size fits all. And any of you advisors out there that understand that, that, hey, what works for one person doesn't work for everyone. And this could be a big thing. It's like I said, it's the bullet that could just hit a client that they didn't even know about. And now here you are, the tax person, telling them about, health insurance, something that we don't even care. I don't even want to know about this stuff. It's almost like I can't even ask you about your medical situation, but I do have to ask you where you're paying for your health care and if you're getting credits. So, separating ourselves from healthcare, but understanding how it works is kind of why I put this one out. Monitoring your client income levels to avoid surprise repayment situations with the healthcare credits. And then using tax strategies to manage income thresholds. Sometimes when people's income starts to grow, there are these other things that start to go away. Earned income credit goes away. Healthcare premium credits can go away. These are things that we want to be bringing our smaller clients into as they start to grow. I mean, a lot of my clients started off their business the same year they hired me, and they grew and grew and grew. And then these are things that they're getting hit with. And you can leverage yourself as an advisor to say, hey, if you check in with me quarterly, we'll be able to avoid these big bullets that could just hit you, like the big, oh, you got to pay all your healthcare premium credits back because you made more money. Nobody likes to hear that, but we're the ones that have to break it down. So this is where tax planning is not just about saving on your taxes. It's about making sure your clients aren't hit with unexpected financial consequences, big tax bill. So why business and real estate clients really need advisory services and why they're bad compliance only clients is for things like this. For real estate investors and business owners, advisory is not optional. If they only want tax prep, I tell them to go to do-it-yourself software or go to somebody local. They're not going to like it. They're going to prefer working with me. And that's the reason why, is because they get a little bit of a full advisory service. And sometimes they just don't understand that. So sometimes you got to let them feel it and tell them no. That's what our approach is, not taking clients that are compliance only, especially if they have real estate investments and or a business or businesses. Those firms that are doing compliance only, Intuit, TurboTax, the local shops, they have a different business structure than us small firm owners. And they give clients, in my opinion, a different type of service. They're not answering questions holistically. They're just kind of preparing a form, and that's what they're selling you. So if you're the one doing planning, here's what you can do. You can help clients map out transactions before they happen. Before that sale happens, let's talk about it. Let's forecast how this would impact your tax bill to potentially save you from an unnecessary tax bill, right? Like in my client scenario with the 1031 exchange, they didn't spend all the extra funds. I could have put the pressure on them and told them, hey, you might want to look into getting another spending all those funds, because not only are you going to get hit with the 15% or so capital gains tax, you've got this unexpected healthcare premiums you're going to have to pay back. But, they didn't want to pay the few thousand or so for advisory services to check in with me. So ended up costing them. And then, of course, they don't like you after that. They want to go somewhere else because you didn't do, you made them have to pay like somebody else is going to do something different. It's, so when you position yourself as a must-have service, not just an expense, you're going to end up giving your clients good results. They're not going to have unexpected tax bills. So if you've ever had to break bad news to a client about unexpected taxes, that's what this episode was for. And on the next episode, I'm really excited. I want to talk to you about my tech stack. The tech stack that I think is essential if you're starting out, what you will need in order to get up and running. If you're at a firm and you're listening to this podcast and you're thinking about going out on your own pretty soon, I have an episode where I'm going to tell you kind of the essential tech stack that I would start with, the first engagement that I would start with going after, and potentially getting out on your own, making those steps. Now, of course, as you go and as you grow, I have a full-blown tech stack mini course that you could see my entire tech stack, how I offer my services, what connections I do with QuickBooks in order to sell advisory and higher ticket services. So hit subscribe, check out some of the links we have below. I want to show you how to add value to what you're doing and what you're already doing so that we can end up scaling smarter. That's what the Scaling Smarter podcast is all about. Thanks.